Bitcoin has to surpass gold. It's a better asset. All around, it's just a superior asset that accomplishes mostly the same thing.
Hi there, this is Laurent. I'm the co-host of Verified, the brand new podcast by Bitcoin Swiss. But this isn't just any podcast. It's your backstage pass into the crypto world. My co-host Dominic and I are analysts in the crypto industry, where it is our job to stay on top of the latest market and crypto developments. None of the discussed is financial advice, of course. It's all for informational and entertainment purposes only.
Welcome to the first episode of the new Verified podcast of Bitcoin Swiss. We are today thrilled to welcome Alex Krüger as our very first guest. Alex is a notorious economist, investor, an advisor, a trader, and overall a leading voice in the domain of digital assets. Alex's reputation builds on his sharp analysis and insights into global macroeconomic trends and crypto markets, as well as their evolving landscape.
So welcome, Alex, and thank you for taking the time to be with us. It's a pleasure to have you here. Maybe just to kick off, will you share a little bit about yourself? Economist, investor, advisor, trader. Did we miss anything?
No, thank you guys. I'm basically all over the place. I started my career about 25 years ago in banking. Did 15 years of TradFi, basically between banking, worked as an economist at the Ministry of Economics of Argentina. I'm Argentine. And about 10 years ago, I went independent, and I've been basically trading full-time for the last 10 years. For parts of that, it was my capital and other people's money, OPM as we call it. And eventually, at some point, I decided that was not worth it. And went full independent. I got into Bitcoin in 2013. For the last 10 years, I started as a global macro trader and a little bit Bitcoin on the side. And with the passing of time, these two things started flipping. And eventually found myself turned into what we call a full crypto degen. I use macro a lot for basically influencing my decision-making. Also, I have a lot of experience trading very short time frames, but even though at present I focus mostly on the bigger picture. With the passing of time and age, I moved out in time frames. And what else? I also have a few businesses. I have a macro research firm. I help crypto projects go to market. So we call it crypto advisory, basically. I mean, the whole spectrum. Yeah.
Very impressive, Alex, that you're like, as you said, like all over the place and kind of a generalist, which can be tough in such a highly dynamic space, right? So regarding the topics, I would like to kick off today's episode by diving into spot ETFs and their impact. So as you know, after more than a decade now of back and forth, the ETFs were finally approved, Alex, and many in our industry consider this to be somewhat of a moon landing moment, right, for the space. Just to throw some numbers at you, BlackRock's IBIT took out the entire assets under management of Canadian Bitcoin ETFs within less than 2 weeks, which is very impressive in my opinion. Then again, less than 3 weeks, the 9 new kids on the block stockpiled more than 150K in BTC. And overall, we are talking about like 1 billion in inflows now positive. Do you expect more severe sell pressure short term stemming from GBTC, as it still holds like 500,000 or 500,000 in BTC? And what do you generally derive from the flows we observed? Is it surprising to you, or was it somewhat expected?
Yeah, the first thing I like to say here is that the ETF is as big as, crypto fans and all of us cheering for it believe it to be. This is not a fad. This is what propelled gold to what it is right now. And if we think about it, there is two major things, two milestones in Bitcoin's history in its entirety. And these are and have always been basically, first, an ETF. Why an ETF? Because an ETF basically means that traditional finance is finally shilling for us, as we say it. They're shilling, they're doing our job, and they're pitching to their people for us. That's how the masses come into Bitcoin. And this also brings large asset allocators, which have a very different behavior in markets, as large asset allocators like pension funds, what they do mostly and generally is accumulate, manage risk a little bit, but mostly they're accumulators. They're not traders, not funds. They don't come in and out like most of us. It's like most people in crypto, hodlers aside, we are hot money. It's like the kind of money that basically goes into emerging markets, that goes briefly into the market following a narrative, and then comes out rapidly. This can generate very large boom and bust cycles in emerging markets. And in a way, if you think about it, crypto and Bitcoin has been behaving since its inception very similarly to emerging markets. So what an ETF does is it starts breaking this dynamic and making it more like developed markets where basically money just stays in forever. So that's the first milestone, is the ETF, and it's very important. And then the second milestone is basically central bankers doing the same. So we have TradFi shilling Bitcoin. Secondly, is going to be central banks shilling Bitcoin. Once central banks adopt Bitcoin as reserve currency, which I firmly believe now it will happen. And that was not the case, by the way, a few years ago. I changed my mind. So the first milestone is behind, and it's a very, very big one. It's just getting started. This is, it's sell the news, true, but short term, because the sell the news is basically driven by the fact that most crypto people and crypto capital, the ones that basically move the needle, not the hodlers, we have a tendency to front run everything. We are front running experts. When basically an event happens, we sell the news. Why? Because we front run it. How do you can tell we've been front running it? You can easily tell this by looking at funding metrics, that basically funding metrics or open interest metrics that basically tell you about the market positioning. So addressing what you were talking about the grayscale flows. Grayscale flows are very real. They've been diminishing. The net flows, including grayscale into ETFs, have been around $800 million, which is extremely healthy. However, for some people who have a tendency to panic due to, I believe, severe PTSD that is deeply rooted in our industry for good reason, they believed that those numbers were not strong enough. Back to grayscale, if you look at the numbers, the grayscale flows, they started diminishing at the end of last week. Now they are lower than inflows, what they call I forget the name, the big nine or the magic nine. Like TradFi people like to put fancy names into things, like, the magnificent seven, the new nine. I forgot the name they use for the 9 ETFs, right? But they're lower now. And grayscale outflows should continue regardless. They're not done. There is a lot of bankrupt states that still need to exit. But the point there, what many people fail to see, is that this is just one part of the equation. There is the other part, which is actual inflows. So that being said, right now, if you look at the market, what you're going to see is very healthy dynamics. Again, grayscale flows diminishing. You're going to see spot leading perps, not the other way around. The other way around is unsustainable. When spot is leading perps, that means we are in a good place. And thirdly, a good way to keep an eye on basically what's happening with the ETFs is they use Coinbase. Coinbase is their custodian, right? So they're settling in Coinbase. So you can use the Coinbase premium or discount relative to the rest of the market. Usually we use Binance as a measure of basically how healthy the market is. When there's a discount, it means that people are dumping on Coinbase. So in this case, now with ETFs, it's like ETFs are dumping on Coinbase. Now it's the other way around.
I very much like your take on that Bitcoin and digital assets are kind of a retail-driven asset class. And obviously, like, we agree very much that the ETF is also, with a long-term perspective, a major step into the right direction. So you also mentioned we see strong parallels to gold when we compare the gold ETF launch with the Bitcoin ETF launch. I checked that the magnitude of inflows very much resembles already what we saw with gold, with the difference that Bitcoin also comes with an inelastic supply property. That means, like, regardless of demand spikes, you can't just produce more Bitcoin. So now I'm keen to know, with the gold ETF enabling gold to thrive and mature, do you think like similar dynamics apply to Bitcoin and the industry in general? And on top of that, sorry for the long question, what is your estimated long-term price impact?
So on price, I tend to ignore analysis that give me a long-term price target, because these analyses are extremely subjective. I try to step away from bigger picture analysis that actually gives me a number, because that number, in my experience, what usually does is cap your upside. Prices tend to run way, way beyond what you're thinking, what we are thinking, especially in asset classes with a trend, unlike Forex. It makes sense to basically remove the price target. Otherwise, that price target may fool us into believing we know more than the market, which we usually do not know more than the market. So just let it ride. On the gold comparison, well, two things. One is let me play briefly devil's advocate. Most Bitcoin is not circulating. The price setters are actually the people, the traders, right? It's not the hodlers. They what they do is they accentuate fluctuations just by withdrawing liquidity from the market. But the point is, given that most Bitcoin is actually not circulating, this means that actual supply would and will increase with increasing prices. So in the midterm, the fact that Bitcoin has limited supply is good for the narrative. It's a very good narrative, and it's good for the long term. But in the mid to short term, it doesn't matter, because higher prices drive increased supply, period. Another point there on gold that is worth mentioning is the inception of the gold ETF. It lined up perfectly with a weakening US dollar. People generally don't talk about it, but the dollar started trading very poorly right after the gold ETF, and that lasted for a couple of years. So one could argue, and one could analyze, and I would love to see this analysis, like this is something I would love to see. I haven't seen it, is any kind of analysis to basically isolate the different variables that actually drove gold higher. It was not just ETF. There was way more than that. Furthermore, on gold and the gold comparison, I firmly believe now, this is, by the way, a belief that I developed in the last few years, that Bitcoin will surpass gold. Bitcoin has to surpass gold. It's a better asset. All around, it's just a superior asset that accomplishes mostly the same thing. Store of value. Okay, gold has an industrial component. 10% of gold demand is for industrial uses. 10% is nothing. So at the end, these are comparable assets, and in a digital world where we are and where we're going more and more with the passing of time, and with aging population, as boomers, as we now call them endearingly, sadly pass away, and new generations come forth that they are born in a digital era, they will favor Bitcoin over gold. It's just it's as crystal as the blue skies, right?
Yep.
So I believe that Bitcoin has a lot of catch up to do. So that's something else and again, on the flip side, on the positive side now, the ETF is not comparable because gold was already a mature asset at the time of inception of the ETF. Bitcoin is not. Most people don't talk about Bitcoin. We talk a lot, people write about it, but the reality is the great majority of the world, across social classes, it's not just a rich thing or middle class thing, don't talk about Bitcoin. They read about it every now and then because somebody writes about it, and now they know what it is, but they're not thinking about it, and they don't own any. So there is a lot of catch up to do. That's why I think the upside is so large. It's so large, and I don't want to think about it. Yeah, it can be a lot of fun actually arguing where Bitcoin should go. And I get this question a lot. And years ago, I used to like stop and run the numbers and put up my models or build models and come up with an answer. Now my answer is sorry, just up only. Just manage your risk in the meantime. Figure it out. Just stay in for the ride somehow.
I think that really sheds a lot of light, but I want to maybe take an alternative view of the ETF, especially with regards to the aspect of self-custody. And with the ETF, of course, that's being lost. And that's one of the primary value propositions of Bitcoin to any crypto native, not your keys, not your coins. Can you shed some light on this point, and if long-term investors should be more cautious when investing in Bitcoin over the long term?
Well, what you said is very true. And I feel identified, but I think it only applies to a very small minority of potential investors. The ones like myself, and quite likely, I don't know you enough to know this, but I would presume that probabilistically you are very similar to myself in your views about not your keys, not your coins, right?
Yeah.
But we are a minority. We're a tiny minority, and we will forever be, I believe, a tiny minority. Most people don't care about that. Most people are very happy having their assets in their banks. Most people are very happy giving their privacy away for free or for some benefits, but giving it away. Even crypto people give our privacy away to Twitter, now X, right? You can be anonymous, but they're still mapping you. So most people, the great majority, does not even think about Google having access to their data and using it for targeted ads. Or the great majority of people don't use a VPN, even though it's so easy to use it. And they think, oh, I have nothing to hide. And that's not the point, of course. It's like you're giving your privacy away for nothing to people who you do not know, that they can use that data to basically know exactly what you are and your behavior. But the majority does not care. So it's the same thing on back to the Bitcoin ETF. Is most people are perfectly happy with a custodian that happens to be Coinbase in most cases to hold their keys. And by the way, Coinbase is a crypto native industry, so we could argue that those buying into ETFs, they're in good hands. There's a lot of things to complain about Coinbase, about their fees, about they listing shit. Some shit is good, some shit is very bad, but they're still one of us. If we were not for Coinbase, many of us would not be here. So we should be very thankful, I think, to Brian Armstrong, rather than attack them. And one other thing is there are Bitcoiners actually that they don't want the stress of holding their coins because they're concerned about getting hacked, or they're concerned about the wrench attack, or they basically literally put a wrench up your, and they take your coins, and it happens, and people do get killed for that. Not many, but it happens. So it has a benefit, knowing that you cannot get robbed of your Bitcoin because it's being held at Coinbase, and to get out of it, basically, that you can't. It cannot be taken away from you because to remove money from an ETF, in this case, they would need to basically sell your position, close your position on your broker, and then from the broker transfer to a bank account in your name only. This takes time, and there's so many hurdles in between. So it has its benefits, and I haven't seen data on this, but I believe that actually there's quite a few people that have sold their spot Bitcoin and bought the ETF for security reasons, and they're happy to pay 25 bips or 30 bips for 0.25% for the service.
No, definitely. Then that is true. I think once you supersede a certain threshold in terms of AUM, it starts to become, a lot more comforting to know that your assets are being held with somebody that is regulated and also somebody that is trusted, right? There are consequences, and I think that also gives you peace of mind as an investor. But that also leads me now, into the second part, which is actually more around the macro environment. And, someone with your experience, I think I'm very excited to learn about your take on this. So, just maybe to kick off, the upcoming FOMC announcement this week is really going to, I think, be quite exciting for the market. And I think we'll see some reactions in the charts for sure. There's a 46% probability that they will cut in March. But given that we have, the labor market really hasn't moved, it's appeared rather strong. And then in the long term, we'll have AI and its effect on the market. Plus, we have some global politics playing out in the Middle East and as well as here in Europe. Do you have a strong position on global macro at the moment from your previous position in June last year? And then following which, I'll just tweak you on short-term views and then medium-term views.
Yeah, sure. I think the only thing that changes positioning.
Okay.
So its position is now slightly stretched, you could argue, short-term players. And this is reflected. There's no alpha there. This is reflected in the charts. That being said, nothing much else has changed aside of China finally turning dovish. Other things are mostly the same. We can go into the minutia, but they're mostly the same. And something, the way I approached 2024 was actually the same way I approached 2023. Consensus was bearish, recession, same analysis, inverted yield curve, etc., etc., etc.
Yes.
So I was right, and it paid off to take the other side in 23. I'm thinking the same way for 24. There is some things that are going to be happening that are very, very positive. The Fed has started talking about basically winding down quantitative tightening. I'm going by what they say. It's at this point, I am going by the fact that basically the Fed has been very consistent since they realized they've effed up in 2021. And they flipped hawkish. They've been extremely on point with their own views. So I'm going with what the Fed is saying, and they're already talking about unwinding QT. So we have inflation coming down. We have interest rates that are going to kind of start coming down. The issue on interest rates is kind of similar to what I was talking about positioning. As you were saying, there is a 40% probability of cuts of the first cut by March 2024, by March, which is not what the Fed is talking about. The Fed has been basically hinting at June, starting in June. So the market is getting ahead of itself. The market has up to 3 cuts priced by June, and it has at about 75% probability. We need to look at the aggregate, but I think if I recall correctly, it's about 75-80% probability of 5 cuts by end of year. And the Fed has been signaling, or it signaled, not has been signaling, it signaled 3 cuts. So either the Fed is right or the market is right. I think that it's most likely that the Fed is right. What that basically means is at some point in likely the near future, we're going to have, the way I see this, I think it's more likely to have a sharp, fast correction of, say, 5%, something like that, maybe a little bit more, Fed-driven. So the correction will be driven by the Fed. It could happen tomorrow. I don't expect anything happening tomorrow. The risk mainly comes on the dot plot, basically the Fed's projections of various things out in the future. In this case, interest rates. That's where the risk comes from, I think. So I think the most likely time for the Fed to basically say, you guys are wrong. You're too dovish, you're too bullish, is in March.
Okay.
What else there? Also, like just to say, like basically, the dot plot is so important. It was the dot plot that basically, the Fed did a 180-degree change on the dot plot in December versus September. That was the infamous Fed pivot that a very large arc of the market failed to see because of because of biases, basically, recency bias, etc.
No, I think that's very interesting. I mean, it's also a rather different approach to some of the others, that you can follow on YouTube and on Twitter, such as Henrik Zerberg, who basically is talking a little bit more about there actually being a recession this year, and saying that's probably going to happen maybe a little bit later in the year, looking at things like the conference index, for example.
May I ask, what's his handle?
It's Henrik Zerberg, I believe. Yeah.
It's a very large account, like 600, like a massive account, right?
It's relatively large. Yes, that's true.
Yeah,
That's true.
if I recall correctly, he's always bearish.
Yes.
Yeah,
Yes, absolutely. You gotta watch out there.
So some people have strong biases. By the way, I acknowledge my bias is generally bullish. I used to go with an approach of unbiased.
Okay.
And at some point in my life, I realized that that's a mistake, because if assets are generally going up, your bias should be up, not neutral.
Yes. How do you assess your own bias, by the way?
How what?
How does one assess one's own bias? Do you like maybe invert the chart? I mean, that's one tool.
First is self-awareness, right? But when it comes to charts, we can just put a linear regression on a chart or moving averages. There's so many ways to measure a trend and the strength of a trend. So based on that, I mean, a very good approach. Stocks just make it easy, and crypto makes it not as easy because of the volatility. But it's for the longer term people, which I recommend, and investors, anybody who is trying to like weed out the noise. We put a trend, we zoom out, and we see, okay, we want to be long here, so let's use counter trend moves, which for basically putting positions against the major trend. Specifically, this is maybe something very basic for much of the audience, but simply change the time frame on the charts, or change the input for the length of the moving averages being used. And by doing that, we can visualize and assess different trends in different time frames. So what we want to try to trade and what we use as counter trend to trade or manage risk, or if we're running leverage, becomes very important. But yeah.
No, nice. So I have another question, and maybe I'm interested to know from you. If we take COVID, right? COVID typically lasted like 2 months, right? So I wouldn't necessarily deem it a systemic financial recession that occurred during COVID. It's more of like a shock moment with a reaction that was just a little bit overreaching. All right. And so if that's not necessarily deemed a financial recession, would you agree then that actually Bitcoin and crypto has not been stress tested in a financial recession up until?
Well, I disagree with the premise, because I think it was a financial recession. And the only reason we came out of it so fast is because the Fed and other central banks and governments took extraordinary measures. Because even though the panic was not justified, not justified by reality and substance, the panic was real.
Yeah.
And the future is path dependent. Prices are path dependent. So if the Fed, I'm going to talk about the Fed because it was the main actor, but there were so many actors. If the Fed has not stepped in and dramatically impact the path of prices, we would have had the largest financial crisis in history, quite likely bigger than 29, because the economy stopped, the world stopped.
Yeah.
I've been very vocal, by the way, that that was a mistake from the beginning. From 2020, people wouldn't follow me, get very upset. We exaggerated. The world went overboard. We did too much. And it was basically driven by panic. So the way it was typical herd behavior. The masses panicked, the politicians panicked because the masses panicked, and that generated a negative feedback loop that basically fed back to the masses and also generated this very sad separation, political separation between those who saw COVID as the end of the world and something to be massively scared about and we're going to die, etc., to those who actually took exactly the other way and said this is nonsense. And by the way, the guys who said nonsense were mostly right, but it's not binary. There's a spectrum in between. I'd say, like my personal opinion, that we were more like on the 75% towards the nonsense side, but COVID was real. There is, like, for example, sorry, I'm going off the branch here. Age of expectancy went down for the first time in a century because of COVID. It was a real thing. So those who say it's nothing, they're wrong. It was important, but the panic was not justified. It was not as bad, and it was the first time in history where basically we quarantined the healthy, not the sick. It's insane. There's so many things that could have been done to make things better. Like economic incentives were not right and not put in place to basically generate the right kind of behavior. And
absolutely.
And we have to be thankful for that, because thanks to that, because of how politicians and central bankers panicked, we had this insane liquidity injection that gave risk assets and Bitcoin. It transformed Bitcoin for the first time in history into a risk asset, and it sent us to the moon, right?
Yes.
And we all did very well thanks to that. So
more QE.
Yeah, fair take. Hey, Alex, I would like to dig it a little bit deeper here, because like you recently tweeted, let me tell you, quote unquote, let me tell you why I remain very bullish on risk assets. Now the question is, how does this rather new asset class interplay with these global macro conditions, especially because like the perception of Bitcoin is kind of evolving, right? So sometimes it behaves like a risk-on asset, but at the same time, it's considered to be a store of value or digital gold. Like, how does that make sense? Or how does that work together?
The way it makes sense is by changing framework and seeing it as an emerging asset class undergoing a process of adoption. So that's why correlations are so unstable. Correlations are driven by flows, right? Something interesting that happened on that front is changing perceptions and flawed perceptions of what Bitcoin actually, how it behaves. For almost a decade, people saw Bitcoin as basically something that responded to risk assets and would respond to Brexit and would respond to Cyprus and would respond to crisis in China and outflows, and Bitcoiners would see relationships that were non-existent, all imaginary. Just a desire to believe in something makes you actually see that desire into reality. Perception, it can be reality. Perception oftentimes is reality. So the actual correlation of Bitcoin with risk assets until March 2020 was zero on average. It literally hovered around zero very consistently, positive, negative, very consistently. It was not tied to crisis in China or anything of that. You could also evaluate that and cripple those narratives if you cared for, by looking at the China narrative, for example, by looking at onshore RMB Bitcoin premium. That was not there. That being said, you could also, if you wanted to go in there, it's when trying to assess correlations, it's valuable to not just look at a daily chart. Okay, this is a mistake that most people do. For me, as someone with a mathematical background, it's infuriating actually when people just overlays charts and says, "Oh, look at that correlation." Assets with an upwards trend are going to be highly correlated because most of the correlation is explained by the underlying trend, which are independent from one another, but both go up. And when you look at correlation of changes, which is the way one should be looking at correlations, with the exception of coin-integrated assets, then you'll see that in most cases these correlations don't exist. Co-integrated assets, by the way, is assets that share an underlying trend, like, for example, treasury futures and treasuries. Back to your question, Bitcoin became a risk-on asset March 2020 with COVID, and it ceased to be a risk-on asset on April of 23, which coincided, the correlation disappeared. This coincided with US market makers exiting the market in hordes. So basically it was regulatory driven. Right now, correlation of Bitcoin and risk asset is still very, very small. However, my personal view is that this will pick back up with the ETF. We just need the initial flows to parse through, and Bitcoin is going to start trading more in tune, in line with risk assets. And when we're talking risk assets, we're usually thinking the S&P 500, right? And by the way, that's very bullish, because the S&P 500 always goes up. So if part of your price action is being driven and determined by something that always goes up or usually goes up, that's good if you're bullish and you're an investor. So yeah, that's how I say it. I think it's going to be changing soon back to being strongly positively correlated.
Okay. Hey, that was a very insightful and a great take. I like what you just outlined, and yeah, it's like correlations are a super nuanced topic, and you have to be very cautious to not get trapped in things like pseudo correlations and things like that.
Can I say, Dominic, something before you change topic? This is something interesting. This is something that traders of all kinds, also institutional traders, do very often, which is basically actually just overlay charts. Our brains, because I do it as well, it's like we're wired to try to find patterns that don't exist. We need to understand what's happening. So we look for the explanations, and we see patterns that don't exist, and something that is very common for achieving that goal is basically start looking at different variables, from monetary policy to inflation to how spreads are working, to you name it. There's like an infinite number of variables that we can be looking at, consumer confidence, etc., and try to find which chart right now fits with what we're trading. Oh, it's like the light goes off. It's like, I found it. This is the answer. And it often happens that actually that does explain part of the action, but it's like 3 to 5%. That's not really the determinant thing. It's just a side note.
If I may add, like, what is nice for us who have exposure to digital assets, like regardless of the correlation, like regardless if it behaves like exponential gold or like a beta on tech stocks, usually like Bitcoin and digital assets historically outperform the rest in the majority of years. So that's a nice thing to have in mind.
Yep.
Let's change gears a little bit now and dive into some cycle theory. I think we touched base on it already. Like, cycles are very common for most asset classes, and digital assets are among that category too, because it's a very rhythmic and reflexive asset class, right? So based on your analysis framework, what do you think, where are we in the current cycle, and which indicators do you utilize to support your assessment here?
I don't use any indicators to support my assessment. I just read nonstop. I read nonstop, and I talk to people nonstop, to everybody, actually, not just other traders. And that's how I determine actually my bias. I try to steer away from indicators. Well, I'm not using indicators right now, but I used to use them for basically paint a story. So if you want to tell a story, you use indicators for that. Back to where we are in the cycle, I think we're coming out of the panic part of the cycle. Is too soon to get bearish. Basically, the market is only now starting to accept that recession and the end of the world and stocks crashing 20 to 50% were wrong evaluations or predictions. we're just coming out. There is no exuberance. You can see short-term exuberance in some short-term metrics by risk takers, but there is no broad exuberance in the market yet. I think we're just starting. Yeah, that's the way I see it. I think it's too early to start getting concerned. It's more about be concerned if you're not well positioned, because asset prices are going up, and the cost or the return on cash is going down. So if you are very risk averse or not financially savvy and you're sitting in a ton of cash, well, you have a very serious problem that you need to address as soon as possible.
Yeah.
And I tell that whoever is listening, if you're sitting on a ton of cash, take the time, work a little bit less, try to break the salary mentality and adopt an investor, risk taker, entrepreneur. Can be just an investor mentality. We're in a good place where most of our income is coming from asset appreciation, not salary. And this is even more important in this stage of the cycle, where salaries stop growing relatively and assets start going down. So if you're not asset rich, you're poor. You have a problem.
Sounds like somebody I know. But
sounds like so many people I know, sadly. Yeah.
No, that's it is actually unfortunate, but that's you know what, if you just look at the valuation of the dollar and against gold or any hard currency, it tells you the true story, and you're 100% correct on that point. And the next, I think in the future, it's only going to be hard assets and more assets, not necessarily just Bitcoin, but I think definitely assets, tangible assets in general. On the idiosyncratic side of digital assets, we see rather low leverage levels and funding. So, you know, this plays perfectly into the argument that we are looking at a very rosy short-term outlook for crypto this year in 24. And you know, your view is definitely that what we've seen last year in terms of the bullish outlook is definitely going to continue now in 24. And I think it's very highly possible we can see all new highs in crypto, but also in the stock market as well. Do you potentially see any looming black swan events, you know, that just come from either inside the crypto industry or potentially even from the outside, whether it might be geopolitics, whether it might be something we may have overlooked? Are there any black swans in your view?
Well, by definition, we are always overlooking black swans, right? That same, like I do as well. We all do.
By definition, sure.
By definition. That being said, on the black swan side, black swans usually cost people money because they're concerned about black swans, and they rarely ever happen. And when they happen, they're so big that they give you, as everyone, whoever is a risk taker, they give enough time to react and protect our assets. So generally, I think worrying about black swans is EV negative. The expected value is negative. This can be very tricky because we like to consume information, and negative information has a tendency to attract us much more, which basically drives people to create more negative information, which we consume more, and we pump it up on the algos, and we get this loop, and we are like bombarded all the time, but by very negative things. So that's usually costly. It's very good for engagement if you're in the business of clicks. That being said, the two black swans that I would see are, the first one is reemergence or a new pandemic. I think it makes sense to have a new pandemic at some point in our lifetimes. I don't know when it's going to happen. I have absolutely no alpha, no edge there, but it makes sense for that to happen again. The secondly is basically China invading or attempting to invade Taiwan. It seems likely, probability over 50%, that would happen in the next 20 years. If that happens, we will have the time. We need to sell everything and find things to short. yeah, of course, you can play some relative values or some things are going to go up. But the point is, it would be so big that we need to run. Other things, what's happening right now in Korea, for example, Korea just declared South Korea. They just amended their constitution and they declare South Korea a mortal enemy. That just happened. It's a departure from their prior intent or express intent of eventually reunifying. The experts on the field are talking about how this could be an effort by China to push the US to get distracted and open up space for them to go after Taiwan. That's another potential black swan, basically, war in Korea. I'm not trading this. This is just things I read. I talk about it. If this gets big and bad, it could definitely affect risk premiums and definitely affect stocks. But I'm not trading it. What
I think
else?
it's kind of difficult to trade. Absolutely. No doubt.
I mean, I think you can, but once the trigger, it's like the Ukraine-Russia invasion. Like there was no trade until a month before. And even though it was years in the making, and it picked up very strongly back in December, early December of 22. But it was untradeable until 2 to 4 weeks before the invasion. So just ignore it. That's how I see it.
I also think like back then, like markets didn't really price something like that in. As you said, like that's why they are called black swans. Let's just hope none of this will materialize in the future. And I want to touch base on what you said, that it's kind of consensus that we get a recession. And based on that, probably a lot of people are sidelined, or like you frame it, not really asset rich. So that would also kind of imply, if they start to realize that the volatility, the upside volatility will be rather high. So what I'm trying to get at is that voices within our industry are getting a little bit more loud around the potential of a so-called left translated cycle. Could you briefly outline for our audience what is a left translated cycle and what are the odds and repercussions of such a left translated cycle?
To be honest, it's the first time I hear the term left translated cycle. I believe I know who you're talking about, people with strong influence in the market on Bitcoin, but it's the first time I read that term, or if I read it, I glimpsed very fast. So what is the left? What is it?
Okay, then I take that, and you will then follow up and give us your opinion on the odds of such a left translated cycle. So what it is basically like that a certain setup occurs, and like that we might observe as of now that the market is just running too hot, too fast. And in the current setup, that might be based on the ETFs with big flows coming in, that then like hits a very major supply constraint in Bitcoin that you outlined before. Plus many people that are still kind of on the risk averse side and are not accordingly allocated with their dollars. So what that would kind of mean is that we see some kind of blow off top within the next couple of months, and then afterwards the bull market is over. So it would just mean that we are translating our cycle to an earlier phase, maybe to 24. Do you think that's a possibility, or is that?
I think it's unlikely. I think it's definitely a possibility. I think it's very unlikely. When it comes to blow off top, Bitcoin already had a blow off top textbook, right? On the ETF launch.
True.
And we are basically retracing the whole move. The arguments for a continued downside, with a few exceptions, most of those arguments came the low 40s, 40K, 40,000 for Bitcoin. We just dropped. We barely even got into the 38s, and we're already up to 43, 44 already. Those views, which were mostly, from what I've seen, tactical views, they've already been proven wrong.
Yeah.
Can we have another blow off top? Absolutely. I find it hard to see another blow off top in this year in Bitcoin, because the public is not yet here. There's no euphoria. Yeah. It's like the euphoria around the ETF was caused by insiders.
Yeah.
So I find it hard to envision a blow off top in 24 in crypto. In stocks, could happen. Could definitely happen, but I don't know. Yeah. Let's see. It's we still, for that to happen, the Fed will need to get very, very dovish, and against a backdrop of a soft landing rather than a hard landing. This is something, by the way, that has been usually that it's tricked people out of their longs or out of the market entirely, is this belief that the Fed going dovish, the pivot, is actually bad for risk assets. And that is only true against a backdrop of a strong recession or hard landing. Otherwise, it's not true. Yep. So it's all really around we're going to see a hard landing or not. The data seems to indicate at present that we won't be seeing a hard landing, and that the Fed has been actually, for once, right. That's my outlook. My outlook is soft landing, diminishing inflation. We can have a few snafus here and there because of the market getting ahead of themselves. Or, for example, in the Middle East, there was, for example, a ship that just got hit by a drone in the Red Sea. So now traders are announcing and talking about halting Red Sea transit. That could escalate. They could drive oil prices up. There bad things can happen, but it's not my base case scenario, and I think it's the right approach. When the perceived upside is so large, the way to manage these short-term things should be different than when we are highly uncertain about the future. I think those calls for a large correction are wrong, and I'd be very surprised if Bitcoin trades 30K this year.
Yeah, I wouldn't mind, to be honest.
I wouldn't mind.
Yeah, we can buy more than, true.
Yeah. I don't want to buy more.
Okay, very true, yeah.
So I think for me, I would like to maybe look at something a little bit more generic and also a little bit more relatable. If you consider that risk on assets are pretty much correlating with global liquidity conditions and the money supply, it's actually really interesting to see that there's a strong correlation between the election years, liquidity cycles, and then the halving cycles. And, what's the story behind Satoshi's choice here? And what is your take on the relationship and that correlation with election cycles, liquidity cycles, and the halving?
Well, that's something that just became a thing about a week ago, right? I think it's mostly coincidental. Two things that matter in the same direction coincidentally. They're both important. I don't think the halving has been a meme. This is something that people are now talking about it because of that chart that shows basically how BTC supply has been moving in line and the price as well with liquidity. That being said, I do think that the halving, the further along we go towards the future, the halving will become a meme because it's simple math. The impact of the halving diminishes. It gets cut in half every 4 years, right?
No, absolutely. Thank you for the feedback. I think it's absolutely fair. And like you said, we're always looking for patterns, right? Sometimes they make sense, sometimes they don't. So we have to also assess whether they actually have a serious impact or not. But thank you.
So I think as we inch closer to the end of this great episode, it would make sense to kind of shed some light of digital assets outside of Bitcoin. What do you think about Ethereum and ETH, the asset, as of now? Because all eyes were on Bitcoin for months now, maybe even more than a year. How do you assess ETH here, and what are potential external and internal catalysts for ETH and its performance outlook?
So first of all, I love ETH. I use ETH. It's great. Now,
Agree.
Right answer.
that being said, ETH is a slow horse. It's relatively older tech. Makes sense. It's a fact. It's the first, right? It's the first blockchain with smart contracts. All of us, we already hold ETH. So it's harder for ETH to move. This does not mean bearish. It means bearish relative to other assets. For ETH to speed up and not be a slow horse, it needs the ETF narrative. And the ETF narrative is not guaranteed. It's highly uncertain. Like the Bloomberg guys, who are the guys who've been driving the ETF narrative for Bitcoin very successfully, and hats off to them. They're pinning the probability of an ETH ETF by May of 60%. The way I see that is twofold. On one hand is I think it's overly optimistic, because the way I see it is it's highly unlikely that we will have an ETH ETF for as long as Gensler is the chair of the SEC. He's been very, very clear about it. I think 25 is more likely, because I think Trump will win. Trump winning quite likely means Gensler stepping aside, which opens up the door for an ETH ETF and then all sorts of altcoin ETFs. That being said, I think the market is going to increase the probability of approval. So at some point in the next few months, ETH gonna heat up again and dramatically overperform Bitcoin. And the second driver for driving ETH and helping it not being a slow horse is Eigenlayer. Eigenlayer is the first part of the Eigenlayer move already happened. It's basically people buying ETH to stake, to then restake on Eigenlayer or through other mechanisms, but basically to get Eigenlayer points that eventually get converted into tokens. And the Eigenlayer right now on the secondary market is trading at 10 billion. If I remember correctly, the valuation back in May, June was 600 million. I may be wrong on this. I would need to check my emails, but
Comes close, yeah.
It's up a lot, and the market is expecting this to actually, we're gonna be seeing 20 billion valuation by the time when Eigenlayer goes live. That brings all this money into ETH holders, and a large chunk of that would quite likely flow into ETH itself. Just like, for example, Solana right now is doing very well this week, because tomorrow there is one of the largest airdrops in history of crypto, which is Jupiter. And the market is naturally and rationally expecting that to pump Sol. That being said, and to wrap that part up on ETH, is I think ETH has too much competition now. There's way too many other chains. These chains compete with ETH. They don't compete with Bitcoin. So examples, Monad is coming out in quite likely late H2. Monad, I expect Monad to be absolutely massive.
I fully agree.
Yeah, it's going to be massive. Eclipse is coming out. Scroll is out. It's doing extremely well, and somehow it's doing extremely well, and it's outside of the perception of the crypto narrative, Core, another one, Core DAO, it's another massive layer one, and this one is a layer one, not layer two, that has absolutely massive number of holders, and a lot of holders in emerging markets. There's so many chains out there. You have Aztec, for example, coming out in Q1 25. And then all the other ones that we have Say, we have ING, we have Sui, Aptos. There's quite a few. And then on top of that, we have all the Bitcoin layer 2s and all the ordinals movement, which I think is going to remain being very big. There's something interesting happening there, which is new Asian money is flowing into Bitcoin layer 2s. So it's kind of the way to think about it is ETH is a second, third generation asset that everybody in the West already holds. We already made our money. So we are attached to it. We protect it, we shield it, we pitch it. The new guys, they don't want to buy our backs.
Yep.
they want new backs. They want new communities. They also want to get rich. So
New shiny thing.
that's why ETH. They want to bet on newer, exactly. So ETH is not the answer there. That's how I see ETH.
That was very insightful. I didn't know that you're so deep in the crypto native space as well. Otherwise, I think I would have put more emphasis on content around that. But I also feel, just to consolidate what you said, I think I agree on the majority of points. Like there are basically like two verticals. The one is kind of the external vertical. So is there an ETF coming? Because if we get an ETH ETF, it will be very big, given the relative size of Ethereum compared to Bitcoin.
Massive.
And it's like a kind of an easy sell. You have that ESG thing going for ETH. Then you have kind of a deflationary cash flow asset, which is nice to sell. So everybody that offers an ETH ETF will at some point also like profit off of these kind of staking rewards. And then the second vertical, kind of what you outlined, is within the tech stack, like let's say a lot of interesting developments. I fully agree the competition is major, but we had that last cycle already, if you remember, with all the Ethereum killers coming up, such as Avalanche and the like. So I'm very keen to see how the modular narrative plays out against this integrated narrative that kind of Solana and Monad and so forth are chasing. Because for both camps, there are like very good arguments to make. I feel both are very important, and I'm happy to monitor what happens. And lastly, we also very closely monitor Eigenlayer, and we fully agree that this will be like one of the most transformative things, maybe the biggest thing after the launch of Ethereum that we witnessed within our rather new asset class.
No, awesome. Thank you. I can't disagree with any of the points. As you said, Dominic, we didn't know Alex was so deep on the crypto native side. And I think we can definitely have another podcast just to talk about that. Yeah, absolutely. So just as we approach the end of the podcast, within the digital asset space, we've spoken so much about digital assets. Maybe you can share with us a little bit about what other sectors or assets that you like to focus or invest in. Is it commodities? Is it just stocks? From a diversification perspective, where you place your focus?
It's my liquid book right now is 90% crypto, 10% awesome. AI stocks.
Very nice.
AI stocks. Okay, yeah. That's exciting.
And it's not that exciting. I barely trade those. I just hold them. They're like big names. There's no alpha. It's Nvidia and Microsoft mainly. So it's I'm not a good person to like. I can go over how to construct a very well diversified portfolio to basically suit different desires and even though that would be financial advice, but I can do it. But it's not what I do is not really applicable to most people. I'm at the very end of the risk-taking spectrum. I'm an extreme risk taker. So my alpha is mostly in crypto, and I love crypto. It makes me happy aside of making me money. Yeah. So keeps me makes me wake up every day wanting to work. So. Nice. I'm mostly crypto, and then I have real estate. You could say it's diversification, but it's not really. It's more for family reasons. Let's put it that way. If I would be absolutely alone in the world, I would have absolutely no real estate. It's a very bad investment. If you are a good risk taker, real estate is a bad investment.
I agree with you there, but it's completely balanced on the other side for, the very simple reason of family that you have property, but which is not maybe the greatest investment, but it's very important at least that you don't have to worry about it going away or someone taking it away or saying, ciao, it's stable in that sense. So no, that makes perfect sense. So maybe last but not least, what are your top 3 hottest takes for 2024? Just be bold.
I think we're going to be seeing all-time highs this year, at least Bitcoin. I think that Solana is absolutely massive, and it's underpriced relative to ETH. What's happening in Solana is absolutely incredible. And I think everybody should be long Sol. It's the perfect chain for retail risk-taking. Let me quantify this. You get with meme coin, with hat, right?
Yes.
The dog with a little hat.
Dog with head.
With is trading, well, I haven't checked in a few days, but it's trading, is doing about $40-50 million in daily trading volume. Daily, every day. That's
Sure.
They're basically making $100K a day on fees. That's all retail, and you turn around and you go to ETH, and there is not a single meme coin on the ETH side doing more than $3 million a day. It's product market fit. The retail degens, Solana is perfect for them. ETH is absolutely the opposite. And then, okay, there are so many other chains, but this is the thing. There's only 2 real chains with smart contracts that right now have a strong native community. They're ETH and Solana, nothing else. Everything else, as of now, is dominated by hot money. ETH and Sol, they have natives that live there. So there's some people in Sol that they don't know anything outside Sol. So then back to Sol, there's a lot of very good applications that don't exist on ETH because of speed and how cheap it is. Like, for example, Hive Mapper, right? I think there's going to be so much more innovation happening in Sol that cannot happen in ETH. Another one is I still think the valuations, if you're really bullish as I am, the optimal path is to be investing as much as possible rather than trading, especially given that valuations in crypto have not yet adjusted from 2023 levels or have barely adjusted. Beyond that, you also have a set of very, very strong builders and founders that have been basically grinding through the bear market. So it's high caliber teams building good products. Another one, for example, Solana one, Parcel. It's a platform that enables trading of real estate. It's something that Sol makes it happen. It's very valuable and it's just getting started.
I love your comment on the positives of Solana and how you can have innovation on Solana, but you can't have it on ETH, and that's purely for like structural reasons. And it just distinguishes the two assets completely. And then also to come back and say, actually, you know what, ETH has so much competition, and that's also a fact. The Bitcoin Suisse global crypto taxonomy will show you exactly how many participants there are in the smart contract platform sector. And so it's really nice to see how your framework fits so well into a lot of the research content that our research team and Dominic has produced. So yeah, no, thank you. I really like it.
Likewise, thank you so much. I mean, honored to be your first guest, 100%, and to the audience, thank you.
Disclaimer. The information provided in this podcast pertaining to Bitcoin Suisse AG and its group companies together Bitcoin Suisse is for general informational purposes only and should not be considered exhaustive and does not imply any elements of a precontractual or contractual relationship nor any offering. This podcast does not take into account, nor does it provide any tax, legal or investment advice or opinion regarding the specific investment objectives or financial situation of any person. While the information is believed to be accurate and reliable, Bitcoin Suisse and its agents, advisors, directors, officers, employees, and shareholders make no representation or warranties, expressed or implied, as to the accuracy of such information, and Bitcoin Suisse expressly disclaims any and all liability that may be based on such information or errors or omissions thereof. Bitcoin Suisse reserves the right to amend or replace the information contained herein, in part or entirely, at any time, and undertakes no obligation to provide the recipient with access to the amended information, or to notify the recipient hereof. The information provided is not intended for use by or distribution to any individual or legal entity in any jurisdiction or country, where such distribution, publication, or use would be contrary to the law or regulatory provisions, or in which Bitcoin Suisse does not hold the necessary registration, approval, authorization, or license, in particular in the United States of America, including its territories and possessions. Except as otherwise provided by Bitcoin Suisse, it is not allowed to modify, copy, distribute, transmit, display, reproduce, publish, license, or otherwise use any content for resale, distribution, marketing of products or services, or other commercial uses. Bitcoin Suisse 2024.